The XRP ETFs have been experiencing an extraordinary surge in activity lately. In fact, they've been performing so strongly that Brad Garlinghouse, the CEO of Ripple, has begun highlighting them publicly, pointing to a clear rise in institutional adoption. This shift is significant, and it's worth examining the data to understand what is actually happening beneath the surface. So let's break this down by starting with the weekly volume numbers, because even in a market that has been notably down and dominated by negative sentiment, XRP spot ETFs still managed to generate more than $160 million in volume. That is a remarkable figure, especially during a week where the broader crypto market struggled. Looking at the most recent trading day, Friday, the combined activity from both leverage products and spot ETFs surpassed $70 million. Spot volume alone accounted for nearly $30 million. When reviewing the entire calendar, the trend becomes even more apparent. The performance of XRP ETFs has been nothing short of impressive. Even going back to their strongest day, the 23rd, the volumes were unusually high, especially given the market downturn. These numbers matter because they highlight how substantial the demand for XRP remains, regardless of short-term market sentiment or price fluctuations. What's even more noteworthy is that XRP has been outperforming both Bitcoin and Ethereum in terms of ETF inflows. Recent data shows over $900 million flowing into XRP ETFs during a 13-day inflow streak. This streak ultimately extended to a full 14 days, 2 full weeks of uninterrupted inflows. During this same period, Bitcoin and Ethereum ETFs actually experienced outflows, while XRP brought in roughly $12 to $13 million in new capital, even outpacing Solana. This type of divergence is rare, and it speaks to where institutional and sophisticated retail interest is flowing. It indicates that demand for XRP is not only steady, but accelerating. This momentum is what led Brad Garlinghouse to draw attention to XRP's ETF performance. But before exploring his comments, it's important to look at a perspective shared earlier by Matt Hugin, the Chief Investment Officer at Bitwise. According to him, the decision to launch an XRP ETF now is simple. The regulatory landscape has fundamentally changed. For years, Ripple and XRP were constrained by an existential regulatory threat, the SEC lawsuit. That lawsuit effectively froze real-world adoption and made it nearly impossible for large companies to build meaningful partnerships on the network. There was simply too much legal uncertainty. Hugin explained that now that the lawsuit is gone, the playing field is level for the first time in years. With regulatory clarity restored, the possibility for real-world utility can finally be explored without hesitation. This is why Bitwise moved early with an XRP ETF, to give the community and institutional players clean, straightforward access to XRP via an ETF with a simple, recognizable ticker. He emphasized that the lack of adoption in previous years was not due to the technology failing, but due to regulatory barriers that have now been removed. This shift aligns with broader changes across the crypto industry. Regulatory discussions are rapidly evolving, and measures like the Clarity Act appear to be progressing toward full approval by the end of the first quarter of 2026. If this happens, it will significantly open the doors for institutional participation in digital assets. Even today, XRP ETFs have recorded their 11th consecutive day of inflows, ultimately reaching 14 days, totaling more than $750 million. Open interest continues to rise, capital continues to accumulate, and XRP's price has rebounded from the $2 support level. If momentum continues and market structure turns bullish again, projections for XRP range from $5 to $8 in 2026 under conservative assumptions. The larger takeaway, however, is that the entire environment surrounding XRP has changed. Regulatory clarity has brought institutional players back into the conversation, and this environment is what prompted Brad Garlinghouse to highlight XRP from the institutional perspective. At Binance Blockchain Week, Garlinghouse pointed out that XRP ETFs attracted more than $700 million within just a few weeks, a clear indication of pent-up demand from institutions that were previously unable to touch the asset due to regulatory uncertainty. He also noted that crypto currently represents only 1 to 2% of the entire ETF market. He stated confidently that by 2026, there is no chance it remains that small. His reasoning is straightforward. Institutions that were previously on the sidelines are now entering the market, starting with small allocations, then gradually increasing them over time. The pattern is crawl, walk, run, a sequence that has repeated across countless asset classes throughout financial history. Garlinghouse also emphasized that recent volatility did not scare institutional capital. Instead, it may actually be drawing them in. When asked about whether the ETF inflow signals were overhyped, he responded with a firm, "Definitely not," stressing that the reason these ETFs did not exist earlier was purely regulatory. Now that the barriers have been removed, inflows are only beginning. He reminded audiences that while short-term snapshots can show fluctuations, the broader trajectory is what truly matters. Over the long term, crypto ETFs are extremely unlikely to remain a tiny fraction of the global ETF market. This brings us to another important point. There are signs that institutional capital is shifting away from Bitcoin, Ethereum, and even Solana and moving into XRP. The inflow and outflow data supports this interpretation. And on top of that, we recently heard comments from SEC Commissioner Paul Atkins regarding the Clarity Act. If clarity is what institutions have been waiting for, and if clarity is now coming through coordinated legislative efforts, then the scale of institutional entry could increase dramatically. Atkins discussed upcoming crypto legislation and highlighted cooperation between the SEC and the CFTC. This cooperation is aimed at harmonizing regulatory frameworks between cash markets and derivatives markets, an effort that has been lacking for decades. He noted that the current environment is poised for a major shift now that stablecoin legislation has passed and broader market structure bills are progressing. This alignment between agencies could significantly reduce risk and increase institutional confidence. When considering 2026 as a focal point, the picture becomes clearer. Regulators are collaborating on major structural reforms. The Clarity Act is progressing, and institutional ETF infrastructure is already in place. XRP ETFs already hold well over $1 billion in assets under management, and they have been open for only about a month. The question then becomes, what happens when the broader market reverses? What happens when XRP begins to rally again? What happens when institutions have a green light to scale their exposure, and the overall market is significantly higher? The performance of XRP ETFs during a down market gives us a preview. If they can attract these levels of capital under stress, their potential during a strong market cycle is much larger. Many analysts and commentators may still be overlooking what is happening, but the signals are becoming increasingly hard to ignore. Brad Garlinghouse's enhanced confidence reflects this shift. Institutional appetite is growing, and the flows suggest that major players have been accumulating quietly. It is possible that institutions have been influencing market behavior, shaking out retail positions and accumulating during dips. This pattern has occurred in other asset classes throughout history, and crypto is no exception. As we move toward 2026, it is becoming increasingly clear that we are entering a new phase in the crypto market cycle, one defined by liquidity expansion, prolonged cycles, and regulatory integration. The environment today is fundamentally different from prior cycles. With this broader context in mind, XRP appears positioned at a critical intersection of regulatory clarity, institutional interest, and market infrastructure. The developments unfolding now will likely shape its trajectory for years to come. As always, the future will depend on adoption, execution, and market conditions, but the structural foundation supporting XRP has never looked stronger. Not professional advice, Consult a qualified expert as needed.